But for the ultra wealthy, life insurance is this insanely powerful tool that they keep under wraps. There's a reason why the Rockefeller family has their own life insurance company, the Rockefeller Insurance Company. That's because for the ultra wealthy, they use life insurance as kind of like a bank account. But not just any ordinary bank accounts. They use life insurance as kind of like a super bank account that can be used to invest tax-free. It sounds weird, but this is because all life insurance is a contract that has some very nice tax benefits, because politicians don't want to tax the poor widow that just lost her husband. The problem is the traditional life insurance policies that are sold to the masses absolutely suck. They're made to enrich the insurance companies and not you. You buy a life insurance plan, you pay some money every month to your insurance company, and in exchange when you die, the company gives your family a couple $1 million. Nothing more and nothing less. So what the ultra wealthy do is they take this basic contract and they just negotiate better terms. And this allows the ultra wealthy to do something very, very special. They put as much money as they want into their life insurance policy, where it grows tax-free, and then they use that money that they put into the life insurance policy to invest in whatever they want. So their investments grow tax-free.
Your money's safe, it will grow the rest of your life, it will grow tax deferred, you can use your money tax-free, it will get passed on tax-free. It has a lot of other benefits, and so what the wealthy use it is they don't use it as an investment, they use it as like a safe asset. I call it the and asset because they're able to give their dollars more than one job. And so they're able to do that while it's protected, while it's off the radar screen of the IRS because it's not considered income. That's how a lot of wealthy people use it. And then step number 3 is usually to take the money or to utilize the money. You're not withdrawing your money, what a lot of people do, because that would be, in a lot of cases, taxable upon gain. They're borrowing against it or using a third-party bank to borrow against their asset. And as a result, if you borrow against it, it's not considered income. So a lot of wealthy people like Elon Musk and all these people, they're borrowing against the equity in their businesses. Insurance, and when you max fund insurance, that's why a bunch of banks do this, is over 3,000 banks today have what's called bank-owned life insurance. Some of their safest assets in the bank is in bank-owned life insurance. Why do they do that? It's an asset that they can borrow against and key team members and employees. And so many institutions use life insurance not as a death benefit, but as an and as a place to store and use their money.
But not only that, just like a trust, the money that the rich put in their life insurance policies are also protected from creditors and legal penalties. But where things get really crazy is when the rich start borrowing money against their own life insurance policy, and then they use that money to invest in more assets. So basically what rich people do is they put, let's say, $1 million into their insurance policy, and that money in their insurance policy, they invest it into like the stock market or something, and it returns 7%. And the whole game is borrowing like 100K from that million at like a lower interest rate on your loan at like 3%.
So yes, that's exactly it. So in just very conservative numbers, if you borrowed at 5% and you earn 7%, your money in your insurance is continuing to grow and you're getting all the benefits of insurance. But on that borrowed at 5, earning 7, that's a 40% rate of return in the first year. So you're getting a 40% rate of return on that side. And people might say that doesn't make sense. You're becoming the bank. You're using arbitrage. Your investment is the 5%, not the full money, because your money's in your policy continuing to compound. So the same thing goes with making a greater rate of return. The benefit of this is having a dollar doing more than one thing, and the people that borrow against it, they have to make sure that their activities get a greater return than what the cost of borrowing. And if you can do that, you can really have a dollar doing more than one job.
But how does taking a loan out on your own life insurance policy even work? Like, where do you even go to do that?
You could go right to the insurance company and they give you an unstructured loan, no questions asked, and you could just say, hey, I want a $200,000 lien. It's almost like a HELOC, but it's an unstructured. So when you go to a bank and get a loan, you have to pay that money back. An insurance company, you don't have to pay that money back because they know that you're gonna die someday and they have that unilateral contract and they're paying upon your death. So the cool thing is, Jake, you have this outstanding loan, a $200,000 loan, you're doing things with it and you never pay that money back. When you die, the insurance company is going to pay out your beneficiary, your family, minus what you owe them. So insurance is one of the only institutions that doesn't require you to have to pay back that loan because they're hedging both sides. They're hedging your mortality and they're also hedging interest rate. And because they're a lifelong contract commitment, they're gonna last a lot longer than we live. They can play the ultimate long game. And so we call these loans, but they're just a more efficient way to use money. And you can decide if you wanna pay them back because it's either gonna come out of your legacy. Yeah, it's either gonna come out of your legacy or out of your pocket while you're alive.
Makes sense. So when you say unstructured, that means that there's no like repayment terms. Like I don't have to.
You decide. Yeah. Unstructured means you decide when you pay them, if you pay them, how much interest you pay them, and you're really in control because you are the owner of that contract.
But where it really ties everything back together is that when your kids die, you set it up so that the money that gets paid from their life insurance policy goes right back into the family trust.
When kids are born into the Rockefeller family, they buy a bunch of life insurance on them. And obviously the kids are able to buy things and, continue to spend. But at the end of the day, when they die, they have a massive death benefit that goes back to the trust, replenishing the trust on what they spent during their life. So the way that a lot of people can incorporate something like this in their own life is each generation has life insurance and they have what's called max funded life insurance. And so they're using it for like a bank and they're using it to buy other things. And maybe some of them have outstanding loans. Well, what happens when the next generation dies and the death benefit gets paid? That death benefit can ultimately pay back your outstanding loan and you're getting all the benefits of compounding. So we call this the waterfall effect because if every generation had life insurance, you're almost guaranteeing every generation is going to be better off no matter what decisions they make during their life, because they're ultimately upon their death will reset the trust or the family fund, all while giving you control and access to use and invest all while you're alive.
And when Caleb realized that the ultra wealthy were doing all of this, he knew that he had to share it with the rest of us.
So you can think about this from a standpoint of, from day one, you have safety, it's easily accessible, you have great growth rate, you're able to use it, there's built-in guarantees, and you're compounding your money tax-free. That gives you options for the future. And you have protections whether you die or you get really sick before. All that time, you have an asset that's continuing to compound for you. No other asset, no other paper asset gives you anywhere near those benefits, all while giving you control to do what you want with your money. That's what for me was like, oh, from day one, I can control my money and invest it and use it for whatever I want, and I get all the benefits. That for me was like, okay, more people need to hear about this because we haven't been told the truth as it relates to the power of this asset.